There is an expression that all good investors and traders abide by, which is cut your losers short and let your winners run. This is true whether you're dealing with stocks, commodities, and even cryptocurrencies. In other words, losses must be small and insignificant, and profit must be exponentially larger by holding and compounding. Another way to look at this is that losses must be capped and profit must be uncapped. And the way to protect your capital is through a combination of risk management and exit management rules. The challenge that many face is they have this logic reversed, where losses are uncapped, often through greed and a lack of structure, and profit is capped, usually through fear of losing profits and a lack of a proper process. It is an unsophisticated approach, very much in line with gambling. So if improving your stock performance is important to you, then this has to change, and I'm going to help you change it in today's recording. I'm going to share with you the exact risk management framework consisting of 3 very specific rules that I have used for over 10 years now that will first keep you safe and your capital safe, and second will make you profitable. So if this recording helps to up your investor game, don't forget to like, subscribe and hit the bell notification. My name is Zahir Anwari. I'm the co-founder of SublimeTrading.io. We have helped hundreds of private investors over the past 10 plus years profit from trends in the market through our simple to learn methodology. I also write for a number of publications, including Benzinga.com, and I'm regularly invited to guest speak on how everyday people can skyrocket their stock performance, focusing on the next 3 to 5 years. So here is a concept that people often overlook. A good investor focuses on capital protection first and lets the profit come to them. Often people will risk it all on a single asset, for example Tesla or Bitcoin, and it then becomes a case of do or die. You either make it or you don't. Some get lucky, most don't. And it is this approach where people lose substantial amounts of money, where trading the financial markets has built up a bad reputation, certainly since the creation of the internet. There are little to no barriers for people to open and fund a broker account with little to no education, and unsurprisingly, it usually does not end well. There has to be an element of accountability here. And it really does not have to be like this, and it mustn't be like this. Sound investing involves a very, very different approach. Now, the very first step, even before we get to the stage of allocating money on an asset we want to add into our portfolio, a step again which is often overlooked, is ensuring you adopt a proven scanning and analysis process that continuously filters out the very best high probability assets. I've covered this extensively in my previous recordings, where I shared the exact process I used to go from over 8,000 assets to the 5 to 10 that I consider for my portfolio. Look guys, if you consistently choose dud assets, you will never make money, no matter how good your risk management rules are. However, switch that around and consistently choose the right assets. Half the battle is won, as the odds are instantly in your favor. It is then a case of translating your analysis into profit, and where risk management plays its part. And we have you covered with this. If you're struggling or don't know how to choose the right assets and want access to the top 10 stocks every week from the UK and US stock markets, complete the scorecard in the description below and unlock your 30-day free access to the Hot Stocks Vault. Okay, with that said and the foundations laid, let's switch over to the slides and go through my risk management framework in detail. Okay, so let's go through my risk management framework and the 3 specific rules that I mentioned earlier. So rule number 1, risk per position. This is typically no more than 0.5% to 2% per position of my overall capital. Rule number 2, risk per day. So this is typically 4% to 8% maximum. And rule number 3, max risk allocation. Typically no more than 10% to 20% of my overall account. And importantly guys, never deviate from these rules. So let's go through this one more time. Rule number 1, risk per position. This is typically no more than 0.5% to 2% per position. So every asset that makes it into my account, I don't risk more than 0.5% to 2% on that one single asset. Rule number 2, risk per day. This is typically 4% to 8% maximum. So at the end of each day, I won't be risking more than 8% of my capital. So over 2 days, it could be 16%. Max risk allocation, typically, that's rule number 3, max risk allocation, typically no more than 10% to 20%. And as already mentioned, I never deviate from these rules. Now, 2 points to take into consideration here on how to allocate risk. First of all, your experience, and secondly, market conditions. If you're new to investing, typically you'll be at the lower end of these ranges, 0.5% per position, 4% a day, no more than 10% risk allocation. As you get more experienced and as you get more in tune with the markets and how they move, and as you get better at investing, you naturally will start moving up to the higher end of that scale. So 2 things to take into consideration: your experience and, of course, market conditions. Market conditions, if we are in full flow and the markets are extremely profitable, then we'll be at the higher end of those scales, because you want to milk the market for everything that it's giving you. If the markets are going through a period of uncertainty, then typically you do 2 things: you either stand aside or you'll be at the lower end of this scale. So that is a really good example of when I wouldn't risk more than 0.5% per position, because then my losses will be even smaller in uncertain conditions. So 2 points to take into consideration: your experience and market conditions, and never deviate from these rules. Okay, what's beautiful about these rules? They help keep losses small. Because losses are small, you're not emotionally attached to any one position. Remember, if you're risking 0.5% on a single asset, or 2% even on a single asset, whether it's a winner or a loser, at the points of it starting to return a profit, in the early days of that position, you're not attached to it. If you're risking 50% on a single asset, you of course are emotionally attached. But by having these very specific rules and keeping your risk small per position, the outcome of any individual position is not important. It's how your portfolio performs overall, which is what counts. Your capital is well protected. As already mentioned, we know exactly what we're losing at every single stage of putting that portfolio together. You know exactly how much you will lose, particularly when your max risk allocation comes into play, that 10% to 20% range. You know exactly how much you are going to lose. And importantly, guys, you are here for another day. What you don't want to be doing is losing all your hard-earned money through greed and a lack of a process and just hoping to get rich, and then ultimately losing everything. And then you've got to start again, saving, putting in the hours. Don't let that be the case. Through these risk management rules, you know exactly how much you're losing. Your money's well protected. Your emotions don't come into play, because you're not attached to any one asset. And if everything goes wrong, which can happen, it doesn't matter. You know exactly how much you're going to lose, and you're here for another day. Think about it, guys. If you lose 10% of your capital, you still have 90% remaining. And by having these risk management rules, you're actually managing your portfolio and you're managing your risk like an investor, not as a gambler does. You're not gambling. You are now transitioning into that mindset of an investor. And that's really where the results start presenting themselves. Okay, so let's put this into a little bit of practice. Let's say we are going to put a portfolio together and we have a holding period of 12 months. So let's say we go through our scanning and analysis process. You know, every portfolio starts with that scanning and analysis process, and at the end of each day, a number of assets present themselves. So we go through the scanning and analysis, and let's say on the Monday, position 1 presents itself at the end of the scanning, at the end of the filter, and we add this into our portfolio with a 2% risk. We do the same on Tuesday. Position 2 presents itself. Let's say these are stocks. We add this into the portfolio with another 2% risk. We do the same on Wednesday. Position 3 on another stock. We add another 2% risk. We then take a 4th position on another stock. That's position 4. That's on the Thursday. And then on the Friday, we take another position. Another stock presents itself through our scanning and analysis, and we take a position. So we've got 5 stocks in the portfolio, each with 2% risk. That's a total risk exposure of 10%. Up until this point, we have stuck to our trading plan beautifully. We've gone through our scanning and analysis process to ensure that we're always picking out the best high probability assets. At the end of that, we've picked out the one asset that looks the best. We've added it into the portfolio. Markets are in good flow. We are not risking more than 2% per position, and we know exactly what we are set to lose at this point. Total risk exposure is 10%. We now say at this point, we're not going to be adding any more stocks into the portfolio. We're simply going to be focusing on these 5 stocks. Okay, so over the coming days, positions 1 and position 3 get stopped out for a 2% loss. Remember, guys, we're playing on probabilities, not certainty. So even though we have gone through a scanning and analysis process that has deemed these assets to be high probability, again, we're still playing on probabilities. There's always a chance that the market will go against us. And that's why risk management and exit management is so important, because there are no guarantees. However, by going through a process of continuously finding high probability assets over the long term, you will make more profit than loss. So position 1 and position 3 stop out for a 2% loss. That is a total loss of 4%. All good. We still have 3 positions open, and we still have the vast majority of our capital still in play. Okay, position 2 is an interesting one, because position 2 doesn't stop out for a loss or a profit. It is basically what we call a break-even position. So we don't make any money, we don't lose any money. So we still have a loss of 4% based on position 1 and position 3. That's all good. Now, position 4 and position 5 are still open. They still carry risk of 2% each. So there's 4% in total on risk on position 4 and position 5. Position 1 and 3 have stopped out for 2% loss each. So there's still a chance that I could end up losing 8% in total on this round of trying to put a portfolio together. That can happen. But what I can also tell you is that by consistently, as already mentioned, consistently picking out the best assets, this is what is more likely to happen. That position 4 and position 5 go on to return you a 10% profit each over the next 12 months. So out of those 5 positions that we had initially at the beginning of the 12-month period, 2 of them stopped out for a loss, 1 of them stopped out at break even, 2 of them, position 4 and position 5, go on to return us a 10% profit each. So that's a total of 20% profit across position 4 and 5. Now, if we do the maths, total profit is 20% from positions 4 and 5 minus the 4% loss for position 1 and 3. That gives us a total profit of 16% over 12 months, which in itself is not a bad return. If you think about what the banking system is giving you, this is a phenomenal return. However, we don't have to stop there. There is something that good investors do that a lot of people don't often end up experiencing, is because they don't educate themselves on how to do that, and that is known as compounding. When a winning asset starts returning you a profit, instead of banking that profit, what you want to do is buy more of that winning asset. So let's look at that in a little bit more detail. Position 4 and position 5 are returning us a profit during that 12-month period. Instead of banking that profit or even just focusing on that one position, we can start buying more of that asset and adding it into the portfolio. This is very unnatural to most people, because the natural thought process is to take your profit. And at the very beginning, I said the goal is to keep your losses capped and your profits uncapped. Often people have their losses uncapped, which is how they end up blowing account, and their profit capped. They take profit too early. You want to move away from that logic, because that's not what's going to grow your account. Instead of taking your profit, add more risk on that particular asset. So let's say position 4 is Microsoft and position 5 is Apple. As Apple and Microsoft start returning a profit, buy more of that asset. So over the next 12 months, through buying more of those assets, which is known as compounding, we then end up with 25% profit across position 4 and 25% profit across position 5. So instead of the 10% that we saw earlier, we now have a 25% return. So let's do the maths here. Through compounding and accelerating the profit phase, when winning positions are doing well and the markets are in full flow, you want to compound. And that's 50% minus the 4% loss across positions 1 and 3. That is a return of 46%. So you can see how much difference compounding makes. Okay, so a question I always get asked is, what is your win rate? Now, this is not the correct way to think. I just want to expand on what we've just looked at. Again, it's that gambler's mindset, because you're thinking in terms of winning versus losing. Often investing and trading is considered a battleground. You always hear about people wanting to defeat the market. It's the wrong mindset. You want to be aligned with the market. You don't want to defeat the market, and you will lose. If you try and take on the market, you will lose. Instead, you want that investor's mindset, and that is where you think in terms of profit v loss. Not winning versus losing, it's profit versus loss. It's not about how many winning positions you have. It's about how large your winning positions are. I'm just going to say that again. It's not about how many winning positions you have, but how large your winning positions are. So I just want to go back to this slide. I just want to explain that in a little bit more detail. Now, out of those initial 5 positions, only 2 were winning positions, which is a win rate of only 40%. So if I told someone I had a 40% win rate, most people wouldn't be too impressed, but that's because they're looking at the wrong metrics. They're looking at winning versus losing instead of profit versus loss. That 40% win rate has returned me a 46% profit over 12 months. That's the metrics that you want to be looking at. I mean, you can't argue with a 46% return over 12 months, risking no more than 2% per position and not risking your account to more than 10%. This is the way to invest, by keeping your losses small and capped and your profit large and uncapped through compounding. And again, guys, it's not about how many winning positions you have, but how large your winning positions are. This is the difference between investors and gamblers. So a quick summary, guys, on the risk management framework. Cut your losers short, let your winners run. Always focus on capital protection. Never ever deviate from the rules that I have highlighted here for you. Don't let emotions get in the way. And remember, guys, it's not about how many winning positions you have, but how large your winning positions are. Okay, guys, I hope you find that useful. I hope that really helps you guys to understand risk management. So if you like today's video, don't forget to like, subscribe, and hit the bell notification. Where do you go from here, guys? Well, to start your journey with us, have you completed the scorecard? Regular visitors, you will most likely have completed the scorecard. If you're new to our channel, welcome. Go down into the description below, click on the link. The link will open up into the scorecard. Are you ready to skyrocket your stock performance? Take the scorecard by clicking on this link. It will take you less than 2 minutes to complete. At the end of the scorecard, you get a wonderful report detailing your performance, and you will get 30 days free access to the Hot Stocks Vault, where we share with you the top 10 best performing stocks every week, saving you all of that time and effort having to look for those stocks, and you instead can focus on making yourself a profitable portfolio. See you in the next recording.